Greetings, Jonathan Camarda. Let's put a period on 2024. So what do we have? We have the Fed coming up this week, up to the plate. Projection is 25 basis point cut to get it into the that rate down into the mid fours. However, shades of gray because coming off of CPI and PPI data last week that showed some inflationary persistence. CPI, in fact, showed 2.7% increase inflation in November. When I look at Truflation, up from 1%, right? It got down to 1% in mid-September, up to 3% now. So pretty interesting dynamics as the employment market, not too strong, but not so weak. So again, depending on with what the Fed's looking at, looks like we're looking at a 25 basis point cut from there. Anyone can project, but nobody knows at this point. So what has that done, though? As we look at bond yields, right, since September, October, up. We look at the 2 and the 10-year Treasury yields up from the 3s into the 4s. Still about a 0.149 spread with a 10 higher than the 2-year there. And, of course, the dollar has been up and away versus the euro, the yen, the Canadian dollar, Aussie, etc., British pound since then as well. So what has that done? Put downward pressure on fixed income, right? So bonds, the aggregate bond index, down about 3% since the beginning of the quarter, October 1st. Now you'll notice on a strategy standpoint, though, active capital preservation, which is a go-anywhere strategy. You might see different kind of funds in there. It's actually flat over that period, again, hedging against just straight fixed income exposure. For more specifics, talk to your personal wealth advisor as I discuss some of those dynamics with clients as well. Now, as far as equities, of course, stronger than fixed income. That's pretty apparent. In the equity markets, however, not all created equal, right? Some got a little bit more muscle. We're looking at your basic discretionaries, your communications, your financials, your industrials, your technologies, and your real estate holding up the top. Of course, one that flew right out of the chicken's coop, healthcare, which, again, you have had very little to zero exposure over the last couple of months as our computer models, look at these trends and the such. And that fever has not broken yet, no pun intended, so we shall watch that as we go. So again, if we look at the National Association of Active Managers out there, equity exposure in the high 90s, right, like July. And again, if you're more aggressive, you'll notice that yours is pretty commensurate, right, as again, the tactical allocations. Now, that may change as we go into 2025, but at this point, that's where it stands from that standpoint. And of course, when we look at the factors, large cap growth been the strongest all year, but we've seen really since November where, some business census is going up. Small caps and mid caps tend to follow, especially small caps. And you'll see some of your exposure as that has been increased over the last several weeks as well. So we shall see as we head into 2025. In the meantime, again, if your situation has changed, a good time to assess with friends and family and the holiday season to kind of get a sense of where you are, and depending on your allocations, if they fit your risk appetite, certainly discuss with your personal wealth advisor, as I do with my clients as well, as again, that's the only thing that is important on how all this applies to you at your proverbial kitchen table. So until then, we will stay eternally vigilant, as again, the last 2 weeks of the year, ho, 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 the Santa Claus rally. A little bit of pullback here recently, generally tends to drift up and to the right. But again, we will stay vigilant. As I say, you stay frosty, just like the snowman. Don't worry, be happy, stay warm.